My dear students, welcome back to our channel. Students, in this video I am explaining MBA third semester. Subject Investment Analysis and Portfolio Management, 5th unit. Important short and long questions and answers. Let's start quick revision. First important short question is: what is Sharpe's reward to variability index? The Sharpe ratio, also known as the reward to variability index, measures the risk-adjusted return of an investment. It is calculated by subtracting the risk-free rate from the investment's return and then dividing that by the standard deviation or volatility of the investment's returns. The formula is Sharpe ratio is equal to return of the asset, risk-free rate, standard deviation of the asset's return. A higher Sharpe ratio indicates better risk-adjusted returns, meaning the investment is providing more return for each unit of risk. It's widely used to compare the performance of different investments. Next important short question is: what is Treynor's reward to volatility index? The Treynor ratio, also known as the reward to volatility index, measures the risk-adjusted return of an investment, but it focuses on systematic market risk rather than total risk. It is calculated by subtracting the risk-free rate from the investment's return and dividing by the asset's beta, a measure of its sensitivity to market movements. The formula is Treynor ratio is equal to return of the asset, risk-free rate, beta of the asset. A higher Treynor ratio indicates that the investment is offering better returns for each unit of market risk. It is used to evaluate portfolios with diversified risk. Next important short question is: what are the benefits of mutual fund investment? Mutual fund investments offer several benefits, such as diversification, professional management, and liquidity. By pooling funds from multiple investors, mutual funds can invest in a variety of securities, reducing individual risk. Experienced fund managers actively oversee the portfolio, making informed decisions. They also provide easy access to a wide range of asset classes, including stocks, bonds, and international investments. Mutual funds are relatively liquid, allowing investors to buy or sell shares on any business day. Additionally, they provide small investors the opportunity to participate in broader, more complex markets with lower capital requirements. First important long question is: discuss the features of mutual funds. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of securities like stocks, bonds, and other assets. Below are key features of mutual funds. 1. Diversification. Mutual funds invest in a variety of assets, which helps spread risk. By holding a mix of stocks, bonds, or other securities, they reduce the impact of poor performance from any single investment. This is ideal for small investors who may not have the resources to diversify individually. 2. Professional management. Mutual funds are managed by professional portfolio managers who make investment decisions based on market research, analysis, and expertise. This is advantageous for those who may not have the time or knowledge to manage investments actively. 3. Liquidity. Mutual funds are liquid, meaning they can be bought or sold on any business day at the net asset value (NAV) price. This provides flexibility for investors to access their money relatively quickly. 4. Affordability. Many mutual funds have low minimum investment requirements, making them accessible for small investors. They allow individuals to invest in a wide range of assets without needing significant capital. 5. Transparency. Mutual funds are required to provide regular reports to investors, which includes information on the fund's performance, holdings, and management. This ensures investors are informed about their investment. 6. Variety of fund types. Mutual funds come in different categories, including equity, bond, hybrid, and index funds. Each type focuses on a particular investment objective, such as growth, income, or stability, allowing investors to choose according to their goals. 7. Cost-effective. While mutual funds charge management fees, they are generally more cost-effective than managing a portfolio of individual securities. The fees are often lower than those of actively managed accounts or brokerage services. In conclusion, mutual funds offer a combination of diversification, professional management, affordability, and flexibility, making them a popular choice for both novice and experienced investors. Next important long question is: types of mutual funds. Mutual funds come in various types, each designed to meet specific investment objectives. Here are the key types. 1. Equity mutual funds. These funds primarily invest in stocks or equity securities. They aim for capital appreciation over the long term by investing in the shares of companies. Equity funds are generally higher risk, but they offer the potential for higher returns. They are ideal for investors with a long-term investment horizon and a higher risk tolerance. 2. Debt mutual funds. Debt funds invest in fixed income securities like government bonds, corporate bonds, and money market instruments. These funds focus on generating regular income with lower risk compared to equity funds. Debt funds are suitable for conservative investors seeking stability and predictable returns, especially in a low-interest rate environment. 3. Hybrid mutual funds. These funds invest in a mix of both stocks and bonds, aiming to provide a balance between growth and income. The allocation between equities and debt varies depending on the fund's strategy. Hybrid funds are ideal for investors who seek moderate risk with a combination of capital appreciation and income generation. 4. Index funds. Index funds replicate the performance of a specific market index like the S&P 500 or the Nifty 50. These funds are passively managed, meaning they aim to match the performance of the index rather than outperform it. They offer lower management fees compared to actively managed funds and are suited for investors who prefer a hands-off, long-term approach to investing. 5. Sectoral theme-based funds. These funds invest in a specific sector of the economy, such as technology, healthcare, or energy. Sectoral funds tend to be more volatile and carry higher risk due to their concentrated exposure, but they can offer significant returns during periods of strong performance in that sector. 6. Liquid funds. Liquid funds invest in short-term instruments such as treasury bills, commercial paper, and certificates of deposit. These funds provide high liquidity with low risk and are used by investors who want to park their money temporarily with minimal risk. In conclusion, The different types of mutual funds cater to varying investment objectives and risk profiles, allowing investors to choose the one that best aligns with their goals, whether it's for growth, income, or preservation of capital. Next important long question is schemes of mutual funds in India. In India, mutual funds are offered through various schemes to cater to different investment needs, goals, and risk profiles. The key mutual fund schemes available are as follows. 1. Equity schemes. These schemes primarily invest in stocks of companies across various sectors. They are aimed at long-term capital appreciation and carry a higher risk due to market volatility. Equity schemes include large cap funds, invest in top 100 companies with large market capitalizations, offering stability with moderate growth. Mid-cap funds focus on medium-sized companies, balancing growth potential with moderate risk. Small-cap funds invest in smaller companies with high growth potential but higher risk. Sectoral thematic funds invest in specific sectors, example, technology, healthcare, or themes, example, ESG funds, to capitalize on sectoral growth. 2. Debt schemes. These schemes primarily invest in fixed income instruments such as bonds, corporate debt, and government securities. They are suitable for conservative investors seeking stable income with lower risk. Types of debt funds include liquid funds, invest in short-term money market instruments and are used for parking funds temporarily. Short-term debt funds, suitable for short to medium-term investment horizons. Long-term debt funds invest in long-duration bonds, offering higher returns with longer investment horizons. Gilt funds invest solely in government securities, offering low risk but moderate returns. 3. Hybrid schemes. These funds invest in a mix of equity and debt securities, aiming for a balance between risk and return. Types include balanced funds, invest in both equities and fixed income instruments, offering growth potential with some stability. Aggressive hybrid funds have a higher equity exposure, focusing on growth with a relatively higher risk. Conservative hybrid funds allocate more to debt instruments, providing stability with lower risk. 4. Index funds and ETFs, exchange-traded funds. These funds track the performance of a specific index like the Nifty 50 or Sensex. They offer passive investment with lower management fees. 5. Solution-oriented schemes. These include retirement funds, children's funds, and other goal-based schemes. They help investors plan for specific financial goals. In conclusion, mutual fund schemes in India offer a wide range of options across asset classes, catering to varying risk appetites, investment horizons, and financial goals. Investors can choose schemes based on their individual preferences and objectives. Next important long question is: critically discuss the regulation of mutual funds in India. The regulation of mutual funds in India is robust and designed to protect investors while ensuring transparency and accountability. The Securities and Exchange Board of India, SEBI, the regulatory authority, oversees the functioning of mutual funds in the country. SEBI's regulations are aimed at maintaining a fair and transparent market, preventing fraud, and promoting investor confidence. Key regulatory features: 1. SEBI guidelines. SEBI introduced mutual fund regulations in 1996 and since then, it has continuously updated them to reflect changing market conditions. These guidelines cover the structure, operation, and functioning of mutual funds, ensuring proper governance, risk management, and disclosure practices. 2. Registration and compliance. All mutual funds operating in India must be registered with SEBI. Fund houses need to comply with strict norms regarding the appointment of fund managers, trustees, and auditors. SEBI also mandates regular reporting of financial performance and portfolio details, ensuring transparency. 3. Investor protection. SEBI mandates that mutual funds provide full disclosure about their investment strategies, risk factors, and fund performance. They are required to publish a key information memorandum (KIM) and a detailed scheme information document (SID), which help investors make informed decisions. Additionally, SEBI enforces a cap on the fees and expenses that can be charged to investors. 4. Liquidity and redemption. SEBI ensures that mutual fund units can be bought and sold at the prevailing net asset value (NAV) on any business day, giving investors liquidity. It also mandates that all fund houses maintain a minimum liquidity level to handle redemption requests. 5. Risk management and transparency. Mutual funds are required to disclose their risk management practices, including the use of derivatives and other complex instruments. SEBI also insists on regular performance disclosures, ensuring that investors are well informed about their investments. Criticism and challenges. Despite a strong regulatory framework, some challenges persist. The complexity of certain fund schemes can confuse retail investors, especially those with low financial literacy. Moreover, there have been concerns about high expense ratios in actively managed funds, which may eat into returns over time. Conclusion. The regulatory framework for mutual funds in India, led by SEBI, provides a solid foundation for investor protection, transparency, and market integrity. While the system is relatively robust, there is still room for improvement in simplifying investment options and ensuring that costs do not undermine long-term returns for investors. With the following details, evaluate the performance of the different funds by using Sharpe, Treynor and Jensen methods with RF is equal to 5%. Let's evaluate the performance of the different funds using Sharpe, Treynor and Jensen methods based on the given data and assuming a risk-free rate (RF) of 5%. Given data. 1. Sharpe ratio. The Sharpe ratio measures the risk-adjusted return by comparing the excess return over the risk-free rate to the standard deviation of the fund. Calculations. Fund A, Fund B, Fund C, Fund D. 2. Treynor ratio. The Treynor ratio evaluates the return per unit of systematic risk, beta. Calculations. Fund A, Fund B, Fund C, Fund D. 3. Jensen's alpha. Jensen's alpha measures the return of a fund relative to its expected return based on its beta and the market return. Calculations. Fund A, Fund B, Fund C, Fund D. Summary of performance evaluation. Conclusion. Fund B is the best performer based on all three measures. It has a strong Sharpe ratio, Treynor ratio, and a positive Jensen's alpha, indicating it provides the best risk-adjusted returns and outperforms its expected return based on its beta. Fund A has negative Sharpe, Treynor, and Jensen's alpha, indicating it performs poorly relative to both the market and the risk-free rate. Fund C and Fund D both underperform based on Jensen's alpha, indicating they do not meet their expected return based on their beta values, though their Sharpe and Treynor ratios suggest some level of risk adjusted performance. In summary, Fund B is the most favorable option among the four. Mr. Rajesh is having units in a mutual fund for the past 3 years. He wants to evaluate its performance by computing it to the market. To evaluate the performance of Mr. Rajesh's mutual fund relative to the market, we can use several key financial metrics like alpha, beta, Sharpe ratio, and Treynor ratio. Let's break down the data and compute these metrics. Given information, market beta is equal to not provided, but generally, the market beta is 1, so we will assume beta is equal to 1 for the market. Alpha measures the fund's return relative to its expected return based on its risk, beta, and the market's return. The formula for alpha is alpha is equal to 27.23%. This means the fund has outperformed the market by 27.23% relative to its expected return based on its risk level. Beta measures the fund's volatility relative to the market. Since the fund's beta is equal to 1.12, this means the fund is 12% more volatile than the market. A beta of 1.12 means that for every 1% change in the market, the fund's price is expected to change by 1.12%. 3. Sharpe ratio. The Sharpe ratio measures the risk-adjusted return of the fund. It compares the excess return of the fund, i.e., the return above the risk-free rate, to the total risk standard deviation. The formula is Sharpe ratio is equal to 1.10. A Sharpe ratio of 1.10 indicates that the fund provides a solid return per unit of risk. In general, a Sharpe ratio greater than 1 is considered good. 4. Treynor ratio. The Treynor ratio is similar to the Sharpe ratio, but instead of using the fund's total risk standard deviation, it uses the fund's systematic risk, beta. The formula is substituting the given values. Treynor ratio is equal to 40.71%. A Treynor ratio of 40.71% indicates that the fund has provided a good return relative to the market risk it has taken. Summary of key metrics. Alpha 27.23%. The fund has outperformed the market by 27.23%, beyond what was expected given its risk. Beta 1.12. The fund is 12% more volatile than the market. Sharpe ratio 1.10. The fund has provided a solid return relative to the total risk. Treynor ratio 40.71%. The fund has delivered a strong return relative to its systematic risk. Conclusion. Mr. Rajesh's mutual fund has performed very well relative to the market. The fund has delivered strong returns, alpha of 27.23%, while maintaining a reasonable level of risk, as evidenced by its positive Sharpe and Treynor ratios. The fund is more volatile than the market, beta of 1.12, but it has compensated for that risk with high returns. Overall, it seems like a strong investment over the past 3 years. Students, for other units explanation and other subjects quick revision or explanation links are available in description. Check out once. I think it will be useful to you. Thank you. Thank you for watching. Like and share this video with your friends.